You're listening to Toronto's #1 real estate podcast, powered by Watson Estates. The most successful local real estate investing starts right here, right now. Here's your host, broker, investor, and social media influencer, Bradley Watson.
Good morning, investors. Bradley here from Watson Estates, and you're listening to the largest, fastest growing podcast on iTunes, Spotify, and Google Podcasts for Toronto real estate. We're halfway through September. Today is September 15th, 2020. And although we've had quite a roller coaster of a ride as it relates to COVID and everything happening in our local market this year, the fun don't stop. And we're going to look to what happens through the remainder of this year in coming podcasts. And today there's a few topics specifically I want to dive into for those of you who are savvy investors out there and want to learn a little bit more about our market. I, as a broker and investor, do too. And so we put this podcast together as frequently as possible to put really the best info, the best insights of what's going on in our market in front of you on an ongoing basis. So today, the highlight, the top article of the day as it relates to Toronto real estate was this conversation of buying a rundown house in Toronto. In fact, the top two articles were speaking of the same posting. The BlogTO one called "Another Rundown House in Toronto is on the market for nearly $900,000. And today I want to discuss whether buying a rundown house in Toronto could in fact save you money. Then we're going to transition and talk a little bit about mortgage rates. Ultra low mortgage rates, are they going to be around for a while? Will they go up? Will they go down? What's that looking like as we talk and look at what the Bank of Canada is saying comes next? But my favorite part of today is really this last topic, the idea of figuring out whether Toronto is in a supply crisis and whether that is backed up by evidence. Because according to a Globe and Mail article, an opinion piece, it seems, supply isn't the issue in Toronto. I want to dive into why they say that and really tackle so we as investors understand what are the pressures that are leading to the rising prices, the rapidly rising prices in our local market. And if you're not already, before we get jumping into the content here, make sure you get on our mailing list. We're giving out on and off market properties within a little distance. Right now we're focusing up in Simcoe, Midland, Tay, Aurelia, that area. And we're sending them one out actually today. We've got a bunch of you already signed up. So if you're not on our mailing list and you're looking for high cash flow properties that of course have a budget to be property managed for you, and you want to make some real dollars and cents around the GTA, this is the place to do it. We'll leave that down in the description below of this video on YouTube, but also it's on our channel. If not, just send me a message and I can get that to you. But with the possibility of a new COVID wave, today I thought, you know what better time than to do some inside jokes, right? I never thought the comment back at school, we used to say, I wouldn't touch them with a 6-foot pole. We never truly thought that would become a national policy, but here we are. Meanwhile, real estate continues to do fantastic, and we're seeing articles like this, the one that I mentioned from BlogTO, discussing a rundown property. The address for you, by the way, is 538 Quebec Avenue, and they say this. They don't try to hide the fact that the building is going to need a bit of tender loving care before it's fully move-in ready. Anyone who knows anything about Toronto real estate could tell you that a downtown house going for less than $1 million is very likely good to be true, too good to be true. And there's one recent listing that certainly serves to prove this point. And so there's a highlight on this particular property. And I love some of the descriptions of it. Pepto-Bismol was evidently a source of inspiration for the previous homeowner. Pink is a recurring theme in multiple rooms here, but unfortunately the gungy, thickly liqueured walls do nothing to soothe the stomach. The busted blinds and outdoor Christmas lights lining the crown molding don't help with the first impression, nor does the fact that no one seems to have given the place a basic clean in years. It's 100 plus years old and a bit of staging wouldn't hurt, but when you own real estate in Toronto, who really cares? The property sells itself, even if it's completely dilapidated. All right, so to its credit, the house offers a yard, more living space than a detached house, right? There was one that sold that they're talking to here, and there was a property. What do they say here? They say, to the credit, the house offers a yard. It sold for more than $1.8 million just last month, but with 3 bedrooms, only 1 bathroom, and a shared wall with the neighbors, it's no $1 million mansion, especially in its current state. That's talking about not this property, but a tiny house shack that came on the market not that long ago. So all that to say, if you can buy a shack for 1.8, now if you got one available for 900,000, what a deal. Well, don't be deceived, guys. Don't be thrown off by this. This is just like in your face, like this is too good to be true. It is. It really is too good to be true. And if you come at it from a different angle, listen to this. Toronto CTV News talking about the same listing. According to the home's description, the property is, quote, a blank canvas for renovators and builders and is located on a quiet street in a hip and lively neighborhood. And they say it's not the first home in Toronto to make news this summer for its high price tag. A 2-bedroom, 1-bathroom home was in Little Italy, recently went up in July for $1 million and received lots of attention for its price, and it sold for $800,000 over asking. Let me ask you guys, and I don't know this for sure, but if I were to hedge my bets, I'd say this property is going to sell well above the list price, right? There is still a huge trend towards getting a top urban location, as they say. Just ignore the fact that a bungalow is there on the property and concentrate on the fact that this has land value, and that's what people are going to do. Not to mention, if you missed our last podcast, go back and check it out. We were talking about this segment, the fixer-upper, the opportunity. We came from the angle of a first-time buyer, but these properties are so hot, they're so difficult to scoop up because there are people at every level looking for these types of homes. And when we look at home prices right now, we see Treb, right, in August, within the GTA, there was a record increase in sales of 40.3% compared to a year ago, and the average price of the home sold is $951, up from $792,000 a year ago. Prices are crazy. The hot market has people who don't have a slice of the pie freaking out, and COVID isn't helping either, right? If they keep stress eating at this level, those buttons on their shirt will start social distancing. So don't get caught up, which many people are because they're the top articles of the day. Don't get caught up in these low price tag homes, and not to mention the fact they're in the news. It's going to be high competition, and it's going to sell well over asking, and there probably won't be that many. Can't talk this morning. Woohoo! All right. There won't be much room. There won't be much margins available to the people who do scoop it up, right? And so if you, as a small-time investor, paying full pop for that renovation, good luck. You don't want a home like that anyways. You don't want a home like that. Stop clickbaiting on those. All right, we're going to move into ultra-low mortgage rates, a driving factor, one of the primary driving factors in my mind of our real estate market right now is ultra-low mortgage rates. They're so low. Well, Move Smartly had an article today talking about what comes next, and it's called this. Bank of Canada confirms ultra-low mortgage rates are here to stay. In its policy statement, the bank offered an updated assessment of the state of our recovery and by association indicated where our mortgage rates are likely headed over the short and medium term. They're not talking about mortgage rates, but this is how it works. So for variable rate mortgages, bring everyone up to speed, they move in lockstep with the Bank of Canada's policy rate. So when the Bank of Canada held its policy rate last week, that meant variable rate mortgages didn't move. The fixed rate mortgages are a little more complicated, but very similar in that they're priced based on the Government of Canada bond yields. So these yields, by the way, are typically determined by thousands of buy and sell orders in the open market, and they usually respond only indirectly to the Bank of Canada's policy rates and actions. But because the bank is now buying $15 billion plus of bonds each week as part of its response to the whole pandemic emergency and its QE, or quantitative easing tools, in its monetary policy, excuse me, these purchases are helping to directly suppress our bond yields and by association, our fixed rate mortgages. Bluntly put, the Bank of Canada's current interventionist policies means that its actions are effectively setting and depressing the level of most Canadian interest rates today. And personally, it's why I'm seeing many people, many high net worth individuals realizing I don't want to be holding cash. If I'm going to get an opportunity where I can get a low interest rate mortgage, the value of that dollar, the loan amount, is going to get eaten up by overspending from our Federal Reserve or from our reserve currency, I'm all in. And that's what people are doing. That's the smart move. It's also why real estate is so hot right now. Here are some of the policy statements, the highlights that came out of what they have to say. Bank of Canada expects that our economy's response to the pandemic will play out in 3 phases. Phase 1, containment. Number 2, reopening. And number 3, which you hope we're in now, is recuperation, which they define as being, quote, slow and choppy. It's going to take some time. It's going to take some time. We've seen immediate bounce backs in things like employment, and we've seen a lot of things recover very quickly. But from here on out, it's going to be slow and choppy. The bank acknowledged that our stronger than expected reopening was, quote, supported by government programs to replace incomes and subsidized wages, but it didn't acknowledge that recent data confirming our federal government's unprecedented fiscal policy response did more than replace lost income. Did you know that we actually, with the spending that came out of the federal government, we increased the average income by 11% in the second quarter? During the biggest downturn since the Great Depression, we had 11% increase. That's unreal, guys. We didn't just meet the need, we overshot it. Number 3, the Bank of Canada noted that the summer brought a sharp rebound in household spending, led by, quote, stronger than expected goods consumption and housing activity. And we've seen that. CPI inflation is close to zero. Obviously, they're focused at 2%, and they're going to be pushing to try and reach the 2% because we're on the low end of that, rather than trying to suppress or reduce that CPI. We're pushing it upwards, which means more spending. And number 5, the recuperation phase will be heavily reliant on policy support with things like the schools reopening and now the possibility of a second wave. We're all hoping that won't happen. Every other pandemic in history, though, has included a second wave. So we hope hope may be with us, but the odds are not. I'll tell you one thing. You best believe I'm clapping on the plane the first place I go after the lockdown. Woohoo! For the pilot, but for the fact that I got out of this country. And not to say I want to leave Canada. I love Canada. But we're all cooped up, right? So here's how they wrap this whole article up. And they say this: against that backdrop, I expect that our fixed and variable rates will either remain at their current levels or more likely continue to drift lower as the recuperation stage of our recovery plays out. And this is all saying, by the way, that we have, for the most part, been able to recover from what we are now. But if you think about it, this possibility of a second closure is not even in the cards. Like the way that they've looked at it from the Bank of Canada, they're not even factoring in the possibility of a second wave, a second set of closures. And that's really, to me, a bit of a concern. John Passalas, he wraps it up like this: 25% of Canadians surveyed by CIBC plan to buy an investment property. That's what happens when you have the feds and the banks giving money away. Surprised it's not higher. Now, COVID, it has some downsides, and interest rates is one of them. We've seen that downside. And here's another one. This morning, I saw a neighbor talking to her cat. Poor lady. The lockdown has her cat understanding her, apparently. I came into my house, I told my dog, and we laughed a lot about it. All right, let's move on here. I want to give some hot topics before we jump into our last and my favorite topic. Usually I don't put my favorite at the end, but when my favorite doesn't follow the news cycle, that's how it lands. That's how it ends up in our recording. So here's some things to talk about. Number 1, better dwelling. Yesterday or a couple days back, our last podcast, we were talking about this idea of Canadian household debt to income plummeting, like dropping a ton. And my perspective of this was, well, many of the doom and gloomers, people thinking the market's going to come down or we're in a bubble, they use this as a primary index to say this is evidence of a collapse. Well, now that number has plummeted so quickly, we finally have someone in the opposite camp that is able to give their take on exactly what's going on. And here's how they say it. The National Statistics Agency said that this is partly due to government support, which means the declines are likely temporary. So they're not pulling back and saying it's a bad thing. What they're saying is it's just a short-lived thing, which is, in my opinion, the right call, right? A decline is considered generally good, they're admitting, while an increase is generally bad. So I like that at least they're being consistent here. Here's how they explain it. The household debt to income ratio dropped to the lowest level in over a decade. The ratio fell to 158%, down 9.7 from the previous quarter compared to the same quarter 1 year before, and it represents a 9.84% decline. This is an absolutely massive drop and completely perplexing at first glance. And then they go on to better dwelling it. Mortgage debt grew substantially, virtually wiping out the decline in consumer credit. So what they're saying, which is a true statement, is people are jumping over from consumer credit into mortgage debt. But my thinking, because they're saying it's like 1-to-1, like you're moving over. But my thinking here is I would rather, like we've seen stop payments and mortgages and instead people putting their money towards consumer credit. To me, that's great, right? Is that not a good thing? I'd rather see Canadians paying, 1.99% 5-year fixed mortgages than 19.99% credit cards? Like, that's just me. I think that's better for spending for Canadians. Now, having debt in general is obviously not the best thing, but in an environment where your dollar is losing its value, why not? Why not hold debt? Instead, they say this likely has to do with government support. Remember, a rise of income can reduce the debt to income ratio as well. So they go on to say how, well, don't forget, because income is higher, obviously your ratio goes up, but we cannot ignore, as this article does, that there is a true decrease in consumer credit. For sure. Absolutely. Huge drops in the spending or of consumer credit. People are paying off those credit cards, and it's a great thing. Unfortunately, it's not everyone. It seems to be the higher net worth, the higher up the food chain individuals that are making those payments. But in general, this is a good thing. It is a good thing. But my point remains, maybe this is not the best measure of determining the success or the risk factor of our economy. I don't think you can have that. And this is pure evidence that now you're kind of cutting corners a little bit on the stats, and you're saying, yeah, it's short-lived. Yeah, it's not really, yes, you've got your pay down, but you also have increasing in your income. So you know what? It's kind of not real. It's not real. The rise in transfers is higher than the decline in income, leading to a temporary decline in the debt to income ratio. As support measures phase out or adopt higher barriers, this number is expected to rise once again. And so they're going to go back to tracking it later on. But in the meantime, a win is a win. Government overspending is not necessary, but paying down consumer credit is great. And I'll take that small win. Okay, another hot topic, this idea of a second wave, right? We just saw from CP24, 10 more cases have been reported in GTA schools, specifically Halton District School Board. They point to a few places in Burlington and Oakville that have had cases. They haven't said if it's students or teachers, but what do you think's going to happen when you put all the kids back in school, right? Start stockpiling your TP and water, guys. Last time we ran out of toilet paper, our family, we had to start using lettuce leaves. Today was just a tip of the iceberg, and tomorrow remains to be seen. Sorry, that was a sick joke. Might have flew over your head. Shut up and move on. Okay, ctvnews.ca, the looming prospect of a second wave. What does this look like? So we see schools are getting hit by a second wave, and now we're starting to hear a little bit of words coming out of our Monsieur Presidente Premier Ministre. Oh man, I'm so glad I dropped French immersion. Yeah, I'm one of those. A widespread return of economic and social restrictions that closed businesses and schools and canceled public events in March is not the preferred option, but there may be no choice, say politicians and health officials. Well, that sounds probable. I don't like the sound of that. It's the preferred option. Canceling public events in businesses and schools. Quote from Premier Ministre Justin Trudeau. The last thing that anyone wants is to have to once again shut down our economies and suspend our lives to try and counter a massive second wave. He didn't say we're not doing it. So between the words of Mr. Ford and Mr. Trudeau, the possibility in my mind of a reclosure is seeming more and more likely, which freaks me out as it relates to real estate. I would even say, in my mind, it kind of is 50-50 at this point, that we could see us scale back at least to stage 2, right? If and when we have closures, in my opinion, all bets are off. It'll be, if I were to kind of visualize it in my mind, and you make this call yourself as an investor, I think it'll be just a smaller version of the March lockdown. It'll be all over again, right? The market will need to be saved, this is the unknown, by government support. So that will be what determines if we get through it quickly. Will the government be there to spend the money? It seems like it's positioned to do so if that happens, but we will see. CERB 2.0. Meanwhile, CERB is ending soon with almost, as I think this is a Financial Post, almost 3 million people will be worse off when it does. It comes from a study from David McDonald, senior economist of CCPA, the Canadian Centre for Policy Alternatives. They're kind of trying to figure out at September 27th, which is the end of CERB, what happens here? Like, how many people are going to be left through the cracks? They say of the 4 million that will be left through the cracks, 2.1 will be eligible for EI, and 781,000 of those won't be automatically switched over and will have to do it manually. Meanwhile, 482,000 former CERB recipients won't be eligible for either EI or a new suite of temporary recovery benefits, which are available to gig and contract workers, caregivers, and COVID-19 sick leave, etc. So whatever your thoughts on this, they're trying to figure out what will be the response or what will be the issues or opportunities available to people with CERB. When CERB ends, are we going to be better or worse off? We will have to wait and see. They're trying to figure that out, and that's up to you to try and decide. But let's see what happens. Our spending happened when we needed it through CERB. Unless we have further closures, I think, in my opinion, it is sufficient. Our programs are strong. They're far stronger than EI was pre-COVID, but we'll see. I don't think we need more, but if we get a second wave, then, well, let's talk again, right? All right, moving on here. CBC.ca, a new poll by pollsters research found, as it relates to Canadians wondering about, should we open the border? What do you guys think? Should we open the border? Well, out of 1,000 Canadians surveyed online at the end of August, a whopping 90% agreed with the current closures to non-essential traffic, right? Our country has become truly introverted. Meanwhile, introverts are out here all like, oh, come on. My mom always told me I wouldn't accomplish anything by lying in bed, but look at me now, Mom. I'm saving the world. I finished Netflix today. Okay, we're going to get into my favorite topic here, guys. I hope you stuck around to the end because this is the best part. This is the best part. This is our big brain stuff. This is the big brain stuff. Ready? The quote, supply crisis in Canada's housing market isn't backed up by the evidence, according to the Globe and Mail opinion. What do you think? Do you think we have a supply crisis? I'm a realtor. I mean, the associations, they're all pro supply crisis. It's the biggest thing. In my opinion, it's the biggest thing. So I'm very intrigued when I see an article that specifically sets out to debate that and challenge that and say supply crisis, it's a mirage. It's a mirage for something bigger, and they talk about it here. Here we go. So if you follow the housing debates in Toronto and Vancouver, you'll have undoubtedly heard the claim that the affordability challenges facing both cities are the result of supply problems. Common complaints including a lack of new housing, burdensome regulation, and flawed zoning. Well, this quote supply narrative has been endlessly repeated. There's only one problem. There's no good evidence for it. Oh, okay. Let's hear your evidence that there's no evidence. Well, here's what they say. First, there has been no major changes in the regulatory framework around supply in either city since the early 2010s. Could that not pose a supply problem? So you clearly get the point here. I'm gonna try and at least give my 2 cents on each of these bullet points, but that seems like an issue. Should we not be improving our regulatory framework, right? As there continues to be increasing in prices, should we not be trying to figure something out to address it? If demand is going up, let's say, we need supply to deal with that. And so anyways, that's their first point. Point 2, the rates of housing construction have remained very strong for several years. In Toronto, the rate of housing completions in the same recent period was second only for recent decades to the pace set between 2000 and 2004. So their point here is that we have record construction. Well, yeah, because we have a supply crisis and there's such a huge need for it, right? We're trying to keep up with the demand from the population growth that we weren't experiencing in 2000 to 2004. The article continues. They say, rightly so, that rather than weak supply, the issue then, this is their point of the article, is an intense demand pressure, including things like cheap credit, which I agree with, foreign ownership, which I think is weak, speculation and high rental demand emanating from a previously strong labor market. That's their point here of this article, is that it's all demand driven. And I would agree there is a ton of demand pressure being put, even in the name of dealing with the supply crunches. Places like TREB are very quick to offer demand suggestions, which are continuing to be problems. If you haven't been following us for a couple months, we've been talking about this. You can't just say we got a supply crisis. Meanwhile, let's make it easier for first-time homebuyers, right? Let's give them more credit. Let's defer land transfer tax. Those things are creating further demand problems, which creates that gap between the supply and demand that we're experiencing. But don't be kidding yourself. Supply is an issue. Just because we're killing ourselves on the demand side does not mean that there's no issues with supply. They are. We're just not dealing with the issue properly. Number third point of this article, sharp increases in housing prices have happened in many cities surrounding Toronto and Vancouver. Even though there are far fewer regulatory and geographic supply constraints in those areas, this suggests that housing prices can rise sharply in the face of strong demand pressures regardless of the regulation in place. Well, with demand pressures, of course, they're going to go up, but I would argue that the pressures in the GTA, the supply pressures, they mirror that of Toronto. So let's not try and disconnect it completely here, guys. There's a reason you're seeing these prices overflowing into the neighboring suburban communities. And if I were to say it out in the air, the biggest problem we have here that is because of supply, and obviously there's a lot of issues and red tape and all of this in getting supply to the market. The biggest problem that we've created, if you look and map it out, was the green belt. The moment the Greenbelt came in, it created an island for our market. I'm not saying I'm for or against removing the Greenbelt. What I'm saying is that applying restrictions to the Greenbelt is the reason that not just Toronto, but the GTA will continue to grow in prices at an exponential rate. And you might say, well, what about the people outside of the Greenbelt? Because, Barrie's not within the Greenbelt. Why are they going up? Because their locality to Toronto and their price affordability is leading to an overflow. It's a spillover, guys. Their point number 4, is the question of zoning. A common claim by so-called YMBYs, or yes in my backyards, and that's a fancy way of saying people who are pro-development. Those activists say that single detached zoning is the central cause of housing unaffordability, since it constrains the land that can be developed and therefore drives up land and housing prices. Maybe you think this too. We got to get past the single family home. There's a lot of talk about this in the Yellow Belt in Toronto. We need to be able to build condos and all that. But then they say this. However, there is no clear relationship between the prevalence of single detached zoning in Canada and the level of affordability in a city. Oh, I think this is the weakest argument, right? So what you're saying is that because Thunder Bay has a lot of single detached homes, it doesn't have a supply crunch. Therefore, we shouldn't either. It's a different environment. We live on a man-made island. It's different. The space that we have here is different. Yes, of course, most homes, areas that aren't going to have affordability issues are going to be single detached because they got all the land in the world. So you're completely jumping over the fact in that article. If anything, they say Canadian cities with the highest share of single detached houses have the least intense affordability challenges, the opposite of the hypothesized relationship. Yeah, there's no need to build condos because they've got lots of land, they get the low rise, and therefore there's no squeeze. There's no supply squeeze. Anyways, I love this though, and I respect the attempt. I respect them bringing forward the counter arguments to there being a supply issue. Maybe you sit in that camp. I think it's few people, but maybe there are a few people who sit on the camp of thinking that supply is not really a big issue. It is demand, and you would be absolutely correct in saying that demand is an issue. And this is what they say. This is how they explain it. Why are we pushing this damn narrative, you biased realtors and you biased home builders? Well, because the narrative is useful to powerful people. Actually, well, okay, I'm completely sideswiping here, but I think it's funny. If someone ever approaches you and says something silly like, the earth is flat, or you get, what's another one? I'm trying to think of something. Or the moon landing never happened. You just bring it up a notch and you turn to them and you say, you believe in the moon? Well, I love conspiracy. So I am all for this, right? But it's the powerful people, right? The supply narrative does two things. It helps stymie action on the demand side, which might actually bring prices and rents down while giving cover to governments who want to pretend to care about affordability for the middle class. It's a useful weapon for developers seeking to gain various policy concessions, including rezoning from municipal governments which deliver windfall land appreciation. So it's the big guys are out there to get you. They're going to get you. Tax them. Wealth tax. Do it. It'll save you. However, housing affordability will suffer to the extent that policymakers either buy into the misdirection or use the narratives to deflect public pressure to take substantive action. I know. Okay, here's my thinking on the whole issue to wrap this all up. There is a supply issue. Okay, there is. Whether you believe it or not, whether I'm wrong or not, that's my stance. There's a supply issue, and we have identified it. The problem is the solutions that are given are demand side pressures, where instead of dealing with the supply issue, we're putting further pressure on the demand side. So I would agree that the demand has now become, in many ways, a bigger issue than the supply issue we face. But that shouldn't overshadow the fact that there is a supply issue. Hopefully that makes sense. But I'm going to wind down, going to relax a little bit, maybe go for a walk or something. The World Health Organization, by the way, they did announce dogs can't contract COVID. So even if we hit a second wave, don't be afraid. Dogs that were previously held in quarantine can be released. So to be clear, who let the dogs out? All right, guys, I hope you learned some stuff. I hope you had some fun today. We're going to leave it there, and I will catch you next time. Make sure if you're not already on our mailing list for on and off market properties with high cash flow returns, we're talking 15% plus positive cash flow. Sign up for that in the link down below, and I'll catch you next time. Take care and keep it real.